So thank you for your time this afternoon. As Scott said, my name is Matt Fischer. I'm with the Clemson AgriBusiness team based in the upstate of South Carolina. And today I get the opportunity to speak to you guys. Basically how I've got it written down here is feeders and forage, looking directly at how our cattle marketings have reacted to some disruptions in the cattle complex as a whole, and even in response to some federal decisions made and geopolitics as well. So with that being said, let's start looking at the national overview and what that looks like, and what's the main kind of impact we're seeing on the national side. And really it has to do with the drought. Not obviously, fortunately, right now in South Carolina, although we are dry, at least here in the upstate, really could use a rain, but more in those cattle heavy states in the upper plains and the west. If you look here, this is that mapped off of your left-hand side of the screen from the U.S. Drought Monitor based out of Nebraska. And that's showing just various levels of drought. It's September 14th of last year. And then on the right, you can see the USDA map of the cattle heavy states, Texas, Oklahoma, Nebraska, Kansas, Missouri. You can see where they're at, where we're cattle heavy, and how that's really playing in to some of the decisions that are being made on the farm. And it's important to note, although I just went back to September 14, this drought really started for them. They started seeing signs of it mid-2020. And as that moved through, it really started ramping up in September of 2020. So off and on in various regions of the country that are heavy in cattle and feedlot operations as well, we've seen substantial lack of rainfall. So this is September 14th, 2021, and this is actually 8 days ago. And you can see that there's been some relief in areas and other areas not. So that's signaling for a lot of our producers in that part of the country to start liquidating. And we'll talk about what that looks like and what that means here in a little bit. But as you can see on the right hand, our cattle concentration really hasn't changed when it comes to numbers on the right hand side with states that are heavy in the cattle production. And this is just kind of further driving the point home. Basically, you see the western half of the United States, that Iowa, Missouri, Arkansas, Louisiana west, our pasture conditions ballparking around 75% of good condition. Whereas once you get west of that line, you're seeing some poor pasture conditions, and that's really going to start putting the pencil to paper for producers, and has been in that part of the state on their decisions on how to market, when to market. So what does all that meteorological, climatological information mean? Means that on a national scale, since 2019, as I mentioned, mid-2020s when they started seeing the drought, but starting in 2019 on a national inventory, we started a liquidation cycle. Nothing to be scared of necessarily. We have these cattle cycles where we'll have expansions and liquidations. You can see in the previous years since '97, we've trended towards liquidation, but our beef production, and I don't have that in this slide, but our beef production has actually increased, although we have a smaller herd size. So we're more efficient with our cattle production in the US. And then I think one last note on the federal or the national scope, looking at feedlot placements. This is some information courtesy of our friends at LMIC. And this is just looking at basic feedlot placements and how the seasonality of those happen, basically how it trends across the calendar year. And you can see as it stands right now in 2022, we're pretty much right on top of where we were this time, well, March of 2021. However, for 2022, we have trended above that 2016 to 2020 average, which means what I just showed you on the national scale. We're putting more animals in the feedlots, therefore, based off of the liquidation cycle, should be no surprise there. Some other signals to that, you can see on our 2018 to 2022 heifers comprise the percentage of federally inspected slaughter. So if you go back to 2018 to 19, when we were still expanding, kind of 19 being that inversion point, we were the lower the percentage of heifers in the federally inspected slaughter, the stronger our herd growth is. The higher that percentage, the more it climbs to that 50% mark. You're going to see it signaling towards liquidation. 2% increase in 1 year, pretty substantial. And then you can see we kind of balanced down to 37. That's where we kind of plateaued there for a little bit. But then we jumped back up 21 and 2022. We're that 38 to 40% heifers on federally inspected slaughter. So, all the signals are there. We'll look at some pricing signals, at least locally in South Carolina here in a moment. But, from the federal or the national inventory side of things, we're in a liquidation cycle, and we'll play this one as it goes. And we'll also discuss here in a little bit why we might be seeing some stronger movement on liquidation with various weights also. So that's kind of a quick and dirty national look. Like I said, I don't want to get too much into the pricing structures and things like that. I think more importantly, it's looking at where we're dry in the continental U.S. and the implications that can bring home to South Carolina producers. And honestly, it's shown us benefit, and you'll see that in the pricing here in a little bit. Just got the updated 21-22 numbers on cattle inventory estimates, or county estimates on cattle inventory. There's no real movement, although we are in liquidation. Pickens County up here in my neck of the woods, we dropped down a color code, if you will. But pretty much, our cattle are inventoried north of that I-20 line for the most part in the heavy counties, and pretty steady inventory below I-20. So it's just more of a visual on those who don't know, where our heavy concentrations are. I think it's always important to kind of illustrate that. So as I mentioned, we're in a liquidation cycle in South Carolina, no different than the federal. Talking that 7-year expansion that we saw up to 2019, we expanded actually at a better rate than the national herd did. National herd was at 6.7, we were at 8.0%. So we had them by 1.3%, which is good. I mean, it showed us that we were confident, at least with our cattle marketing here in the state. Post 2019 into this liquidation cycle, however, we have moved much faster, 3 times the rate, or almost 4 times the rate, sorry, of the national herd. I think there's some signals in there onto why that's happening. I don't think it's necessarily anything to do with the weather. I think it's more to do with the economic climate of the cattle we're marketing. This is just kind of an illustration to show too. January 2021, and so this is our seasonality. I have this in quite a number of my presentations. The purple line is a 10-year average. That's just showing you the volume of cattle that are moving through the sale barns, the 6 USDA reporting sale barns in South Carolina. Your orange line is what we looked like last year. So we really didn't follow a historical average on the pattern. We had some abnormal high marketing there in March of last year, and then we kind of had an early high month, or I shouldn't say early, I said a little bit of a delayed, high month in August, kind of mid-August timeframe, and then we really slumped in October and nosedived in December. It's interesting to watch that. It's also interesting to watch now what we're coming into with 2022. So there's a question on some of those that nosedive in December, and then you see a peak here in February, March of this year. Did we hold some calves on the farm, trying to capture some pricing? That's always an interesting note, because March by far is typically our highest pricing month when it comes to sale barn marketing. And that goes across, I'm speaking on the marketing side, strictly feeders. So, 5, 6, well, really 4, 5, and 6 weights. And March is our higher month. I always stress to cattlemen, though, although you're going to get a higher dollar value per pound on your animal in March, you're also going to have a lot more invested in that animal per pound, because you're carrying them through those mud months at the end of the day, that January, February timeframe. 2021 inventory, like I said, we were kind of talking to the previous slide. We were at 330,000 total cattle and calves January 2021, and we dropped off 20,000 into this January 2022, and just rough numbers, 10,000 of those looked to be brood cows, looking at USDA numbers. So the one thing important to note, that this data right here, this graphing, does not capture cattle, calves, anything marketed outside the state borders or anything outside the 6 sale barns that report. So i.e. like neighboring state sale barns or other premium marketing opportunities. But it does give us some illustration on where and when we're moving, and kind of an insight to what our typical calving weaning and marketing looks like. As I mentioned, talking prices. So this is strictly for 5 weights steers, but looking at these price seasonality movements, and my legend's a little inverse there, I apologize, but you can see black is 2019, orange is 2020, and then purple's 2021. We've seen a nice premium on these calves marketed post-June. A little volatility on the front end of the year, a little unpredictable, but post-June, we've got some nice premium pricing coming in. And that's kind of possibly one reason we're seeing a little heavier liquidation, and those calves getting placed in middle markets in west of the Mississippi, and then maybe even full placements, depending on weights. That being said, pricing, what we look like this year. So last year was purple line, oranges are 5-year, and man, I left the line in green and for 2022 for a reason, because that's some nice, I would not gonna say in the money, but that's some nice positive pricing that we're seeing so far on the front end of the year. That's kind of also indicative, as I mentioned too, maybe those people that held some calves back, maybe, and look for some higher pricing opportunities. If that's the case, then they surely saw it. We're looking, depending on your weight class on your calf marketing, anywhere from 15 to 20% premium price realized. So one thing we want to talk about too is demand, obviously being one of the drivers. And where we're seeing right now, this is from an ag economist at Kansas State, Glenn Tonzer. He puts together this meat demand index and looking at the domestic meat demand, and it's indexed at a baseline of 100 for 1988, just the way he works it. And this is showing the full year of 2021 and the first 2 months of 2022. But in the red, I have highlighted for choice retail beef, all fresh retail beef, retail pork, and retail chicken. Beef, we're seeing good demand, building demand, coming from really close to this time last year to February of this year. It'd be interesting to see how we're holding out in March and April, coming into grilling season. Pork's kind of had a mixed signal, mixed history on the demand. And then chicken is building, trending higher, but still kind of relatively flatline compared to what we're seeing on the beef. I like the previous year, percent change from previous year. It just kind of flattens out some of the noise on the month by month comparison. And then, so domestic demand was driving it. There's a kind of a cheap answer in this that I'll give, that there's a lot of federal money pumped into the economy for consumer spending. And I think because of that, when it comes to meat counter marketing, beef being the premium product, we've kind of, as a beef industry, that's capitalized on it. And then, we had restaurants re-entering the market depending on your geographic location and various constraints due to the COVID lifting. That has offered us a new entry point that we lost during the pandemic. So input costs. I always do this as a 4 Fs, and it's basically obviously the fertilizer, fuel, forage, and feed grains. That's the 4 cornerstones I look at on input costs, obviously not accounting for livestock itself. But so fertilizer, I like to watch, it's a mouthful, but the Green Markets Weekly North American Fertilizer Price Index. It's a culmination of looking at New Orleans FOB DAP, Gulf Coast urea, and Corn Belt potash as your 3 macronutrients to give yourself a commercial blend fertilizer. We saw it from June 2021 to November 2021. The index climbed pretty steadily, pretty evenly, but it still climbed. It fell off after November of 2021, really into December, January, and then with the conflict in Ukraine, or the geopolitical climate, it rose steady and peaked. Matter of fact, it peaked in April of 2022, higher than it had been in November of 2021. But since then, we've started to fall off. Market signals, I think, it's helping, but we've at least bumped back since April. We're kind of back to that January 2022 level. Now, what does that mean for somebody that's out there buying fertilizer? I'm not quoting actual fertilizer prices here. I'm just talking trends in fertilizer. And there's going to be some lag effects, certainly, to the retail market, but it gives hope and insight to more of a large scale viewpoint as to what you're seeing at the local co-op or fertilizer business. Fuel prices, it's kind of a cheap out, but honestly, they're going to continue to tighten profitability. Definitely could offer some logistical problems. We're talking in the cattle industry specifically. Our calves are marketed obviously to the west, and it's going to be keep a close eye on how these energy and fuel prices are going to affect cattle movements into those middle markets and further into the feedlots. So on the forage side, ran some quick and dirty numbers, and I looked at basically just doing a 200% increase in fertilizer price versus a benchmark. Kind of explains itself here. If you're marketing those smaller 4x4 bales, you could see potential just due to fertilizer price break even, potential $43.63 a bale. That's not accounting for fuel increase or herbicide or other input increases. And then obviously you go up to the larger bales, you're widening the margin there on the difference between the benchmark and the increase. So I'm not saying that these are what hay prices will be by any stretch of the imagination. The story here is ultimately expect higher forage prices. And if I can offer any advice to those that are in the forage business and or looking to secure stock hay for the winter, earlier is always better than later, because we could be a drought away from it being even worse than that. So plan for the worst and hope for the best when it comes to this year. Feed grains, quick and dirty, keep an eye on them. We're obviously seeing delayed plantings in the heavy corn crop states. You can do this for the same as soybeans. It's going to look the same. This is May 8th, so we're looking 10 days ago. The blue lines are where the 5-year average is on percent plant. We're obviously substantially less than that in some major corn planting areas. Geopolitics, with Ukraine being the producer it is, of feed grain stock, we'll have to keep an eye on that. And obviously, at the end of the day, high commodity prices lead to high feed grain prices. So feed prices. So it's an opportunity to keep an eye on that. Quick takeaways. Obviously, I'd probably beat this one on the ground enough, but we're obviously in a liquidation cycle. We've got increased production costs, which can lead to marketing of cattle and calves sooner than we anticipate. In conjunction with that, we've got high marketing prices and strong demand. So I'm not saying that we're the sailboat sailing into the storm, but I'm saying that this is kind of a perfect storm for us to see a pretty sharp national liquidation, if not at least regionally. And with that, I appreciate your time. Hopefully it didn't take too long. And I'm going to turn it back over to whoever's in charge of this next.
Thank you, Matt. Appreciate that insight on the rising cost in beef cattle market and forages. And what we're going to do now is want to switch gears and want to introduce our newest doctor, Dr. Steve Richards, is going to kind of give us introduce us to some work he's been doing that hopefully will be a recurring theme as we continue these disruptor webinars throughout the summer and fall. Just going to be a scorecard on evaluating business opportunities. With that, I want to turn it over to Dr. Steve Richards.
Thanks, Scott. Appreciate the introduction. Kevin, if you could make me a co-host real quick, I'll get my slides up. Thank you. All right. I guess today was going to be like an introduction. So I hope that you all that are watching the recording or the webinar live can join in future weeks, and we'll actually review business ideas. When Scott said ag disruptors, I thought, well, you know, there's disruption in terms of bad. There's also disruption in terms of perhaps it's a really good business idea. So I thought, well, let's look at some ways to analyze business ideas and see, are they good? Are they bad? And if it's over the top, is it a disruptor? So what I did is I made a scorecard, and it's the components of a feasibility study, basically. The USDA has 5 sections, but I pushed it down into 4. I combined the financial and economic, but we'll go over each of these sections as a scorecard, and then we can review business ideas with this card. But the 4 sections are technical, marketing, financial and economic, and management. Technical, pretty much this section is like, is the technology reliable? Is it something proven? Is it something experimental? Does it have flaws? Are there regulatory hurdles? Are there things that prevent this from just becoming a plug and play type of idea? And I always like to say, just because it can grow here doesn't mean it should be grown here. As we know, as people in agriculture, yields and predictability of yields is a huge part of whether something's going to be profitable or not. As an example, I used to, somebody in the upstate decided to grow an olive tree, and they said they got one big olive. They said it was the biggest olive they've ever seen, and I can almost guarantee it's the most expensive olive any of us has ever seen. That's the kind of thing that we run across. So if the technology ranking, if the technology is really not suitable for South Carolina, whether it's growing or environmental or, regulatory, could be some serious problems to that being a good business idea. So number 1 through 5 here on the scoring, you get a 1 if it's not suitable for South Carolina, a 2 if it's maybe suitable but untested. 3 in all these rankings is basically like the average, like it's suitable and it's been pilot tested, right? That's average. You know, and you go to 4 and 5, it's been tested or it's widely adopted, you know, something that's plug and play, like I said. The next piece of the scorecard is marketing ranking. Again, we'll do a 1 to 5 ranking on that. Some typical problems with marketing feasibility or business ideas, not enough potential customers, or potential customers are too widely dispersed. And this is like a retail site or an agribusiness opportunity where it depends on people coming to the location. Market saturation, lack of differentiation, that's a huge problem with food products and agricultural products, because especially when we have a commodity base that we're dealing with, that doesn't have any differentiation at all. And some value-added products also have problems with differentiation because food is food. One that I see a lot too, it might be a great business idea, but if the consumer needs to be educated so much that learning curve is so steep that you have to spend 10 minutes talking to them before they realize this is why I should buy the product. That can be an issue. Price is not sufficient to cover the cost of production. And finally, there may be competitive disadvantages or significant barriers to entry. And this shows up also in the economic part. So the scorecard 1 through 5, the lowest one, the market doesn't currently exist. The target market or the target customer is unknown. The product may lack differentiation and or there may be significant barriers to entry. And you go up the spectrum to 5. 5 is the market exists. There's plenty of marketing related data to support it. And the market is larger than a niche market. You'll see the average 3, a lot of new business ideas we're dealing with are niche market, niche products, right? You know, specialty products that 1 or 2 farmers or maybe a group of farmers are doing, but still it's not a national product, it's a niche product. Economic financial. This category or this sector ranks things 1 to 5 on what's the potential for positive net income weighed against the risk of potential losses. What I say here, and I get a lot of folks that have business ideas and they feel it's a mission for them to do it. It's a personal goal. It's a value, very highly valued to them, which is good. I also say just because it's a good idea, just because it's the right thing to do in your mind, doesn't mean it'll automatically make money. The other thing that I see too, and this is more of an economic concept, is that these ideas may not be scalable. You know, you can't replicate it. You can't double, triple, quadruple this idea very easily or at all. And finally, what I see from a lot of prepackaged business plans is that let's take 100% of the yield times 100% retail price, and that can justify the loan to buy this technology or whatever. Well, as we all know, 100% yield or 100% price is hardly ever achievable. We need sensitivity analyses to prove that out. So the rankings 1 through 5 in the economic and financial. 1 means there's some severe challenges, maybe high capital costs or long periods without profit or a high risk of financial failure. And 5 is, you know, this looks pretty good. You know, it's projected to be profitable. It's projected to be profitable fairly quickly. And it has plans in place to mitigate risks that might threaten profitability. The final category is management and staffing. Again, 1 through 5. Really, the success on a lot of business ideas relies on the management and skilled staff. So what this ranking category is, since we don't know who is going to be actually operating the business in real life, I mean, the benefit of a business plan is we can read about the management team, right? But this is just a ranking for business ideas. So how steep is the learning curve for this type of business? Are those managers and staff readily available in South Carolina and rural South Carolina? And in terms of management systems, when you think about record keeping, human resources, things like that, are there systems in place that are readily available off the shelf for this type of business, or do they need to be created from scratch? So our rankings from 1 to 5 on management staffing for a business idea will look at how the situation is currently in South Carolina. A 1 means the needed management and staff do not widely exist. And a 5 is, yes, they exist. Yes, there's management systems for these businesses. And most of these folks reside where this business is going to be. So this is the scorecard. And again, 1 through 5 in each 4 of the categories. Let's move. I don't know if your screen shows the speaker bar in front of the scoring rubric to the right, but 12 basically means you're average. You know, if you get a 3 in each category, you're average. But, you know, average, if you know that most businesses fail, most new businesses, you don't really want to be average, right? I'd say if you're less than average, let's redo that business idea, business plan. If you're average, you have somewhat of a shot. If you're 75% or what's that, a C+, you have a decent chance. But disruptor, I would say you're going to have to be 80 to 90%, getting a 4 or 5 out of each category. And you may be a disruptor at that point, but it's probably a good business idea. What makes a good business idea a disruptor? And we could probably do an hour talk on just this, but I'll put my opinion in there. Pretty much when you see disruption, it means that somebody basically is able to capture a large profit or a decent sized piece of the market rather quickly and able to hold on to it. Strategy would say, I've gained and sustained competitive advantage because of something. And what could those things be? It could be a groundbreaking new technology. It's feasible technology. Nobody's tried it before. This person or business tries it, is successful, and they capture some market. It could just be an idea that has high market potential that nobody's thought of, which there's still room for new ideas out there. Most likely what we see when we see the term disruptor in the news is that there may be low barriers to entry, few players in the market, and a large potential to capture a large market share. Or what we see a lot with investment capital and disruption in industries like taxi cabs and Uber or things like that. There's high barriers to entry. There used to be these medallions that taxi cabs would have to buy in New York City to be able to operate. They're $100,000 a piece. Uber goes in with an app and doesn't have to pay for that medallion, plus has the investor capital to ramp up that business idea really quickly. So they overcome those barriers to entry and are able to capture a large piece of the market almost overnight. It could be any other competitive advantage that's not quickly copied by others. And so that's really what I like to see is like, it's well thought out, got some competitive advantages. Maybe it's location, maybe it's people that can basically propel this idea forward. And so even if you get an 18 out of 20, I think you have to have one of these, a yes to one of these things here too. And I'd be interested if folks have other ideas for what qualifies something to be not just a good business idea, but a disruptor. So in the future, when we get together for the Ag Disruptors webinars, I think it'd be a great, I think it'd be a lot of fun, honestly, I'll go through a business idea, I'll rank it. We'll also have a poll that you can rank it on each of the categories and whether or not you believe this is a potential disruptor or not. So I'd plan to do 10, 15 minutes each segment and have a lot of fun with this. And if there are ideas you want to talk about or look at first, please email Scott or myself. There's my contact information. And thanks for having me on today, and I'll turn it back to Scott.
Thank you, Steve. That was interesting, a different way of looking at it. I like the fact that you can just kind of quickly categorize an idea and see where you need to spend some more time developing or whatnot. So look forward to seeing some live ideas in there and giving us a chance to talk about it. So it'll be fun. I'm going to share my screen and where did it go? All right, so I'm using Apple for probably the second time in my life, and Kevin's having given pointers on how to navigate on Mac. So, again, I just want to take a few minutes here at the end to talk a little bit about the commodity markets, what's going on. And I'd just like to take a look at some of the things I'm watching that I think are disruptors that are certainly impacting the commodity market and profitability of farms in South Carolina. This tension in Russia and Ukraine is not just continues. started back in late February and, not really doesn't look like it's going to settle down for a while yet. Yesterday, Secretary of Ag mentioned that he felt like, based on their data, that Ukraine's grain production is expected to be 50 to 60% of normal for 2022. That's going to continue to hamper not only their economy, but also the food security in the regions that are used to acquiring grain from Ukraine. I don't remember off the top of my head, but some of the commodities Russia and Ukraine supply, 20 to 25% of the exports. So when you cut half of that out, it's really going to change the dynamics, not only of where it comes from, but also the price of what it's going to take to get that grain to these other countries. Currently, the United Nations is discussing some options with Russia, and also with Turkey, to allow Ukraine to export some food in exchange for reducing some of the restrictions on Russia and Belarusian fertilizer exports. So it'll be interesting to see if that kind of conversation goes anywhere, if it allows a little bit more export freedom. And maybe as they start reducing some restrictions, we can see, an end for this tension. Having said that, shipping continues to be a real problem. Diesel fuel prices continue to climb. Just availability seems to be a problem in some areas, and that's going to just continue to hamper the productivity of farms and also other sectors of the economy as we go through the summer. We can't ship it, it's really going to be tough to finish growing this crop out. The way this food security items are impacting us is also unique. Earlier this week, we saw nearly limit up moves in the wheat market, and a lot of that was based on India announcing they were going to halt exports except to those countries that need wheat for food security reasons. The market responded drastically. Wheat markets will show a graph here in a few minutes. We're up quite a bit this week. Later in the week, they kind of backed off of that a little bit, and we've seen wheat prices come back down. But it's getting more and more common that exports are really going to be drivers and influencers in the commodity markets, as we work through these shortages. And of course, most of you know that the prime rate is now 4%. That's up 0.5% compared to last month. The Fed raised the lending rate, and that's going to have ripple effects, both on operating costs and then also on purchase of items like futures and options, where option premiums have a component of interest built into them. So I want to watch interest rates as we go through the summer. What I want to do today is just talk a little bit about the corn, cotton, soybean, and wheat markets, kind of what's new, what's changed since last month, and some of the things that I'm watching. So the first thing I think we need to point out is that last week, USDA released the first picture of what they think supply and demand is going to be for the 2022-2023 marketing year for each of those commodities. And I'll spend more time on corn, and then if time allows, we'll look at each of these other crops. But the big thing to look here is that the acreage for corn is down drastically. You can see that in 2021, we had a little over 85 million acres harvested, and it's down to just under 82 million acres in 2022. Normally, when you see a decrease in acres, you typically would see a bump in the yield because you figure you take your least productive acres out first. But right now, USDA is using the same yield for 2022 that we had in 2021. of 177. And the reason behind that was that the slow planting pace that Matt mentioned, they feel like the yield, the top end of the yield has been lost. And so we're using a lower yield starting out of the gate. The big thing to me is that if you look at the total demand for 22-23 corn, it's 14.5 billion bushels of corn. And if you look at our expected production, it's only 14.4. So we're intending to use more corn than we produce this year. And that's causing a drop in ending stocks. And therefore, we're seeing some price pressure. As you look across there, the biggest change is in the beginning. The beginning stocks are up. Production is down, roughly 600 million bushels. Feed usage is down. Ethanol is about the same. Exports are down. It's just our reduced production overrides some of the reduced demands because of price. So we're going to continue to watch the corn price throughout the summer and try to come up with a good marketing plan. One of the things I like to watch are these moving averages that are in the center of the screen. What's interesting is I'm showing a 5, 20, 50, and 100-day moving average. And what that's doing is just averaging the prices for those time periods. And when you look at the 5 to 100-day moving averages, you can see that each short-term average is a higher price than the next longer term. So like the 5-day moving average is at 753, the 20 days at 740, the 50 is lower at 705, and the 100-day average is at 641. So there's this increased price has just been building, and it's very apparent when you look at the December corn chart down in the lower left. You can see that we've been trending up since the invasion of February 24th, and we've been following that trend line all the way through. Had a couple of days last week where we fell below that trend line, but since then we've rebounded up. Be interesting to see when this market finds a top, but right now, with production concerns in the US, we may not have found the top end of the corn market. Soybeans, on the other hand, are a little bit different story. Looking at the supply and demand report that came out last Thursday from USDA, to see that soybean acres increased from 80, or harvested acres are projected to increase almost 4 million acres compared to last year. The yield is slightly higher than the past. Planting delays in soybeans are not as serious as they are in corn, and USDA is sticking with their trend line yield of 51.5 bushels for soybeans. Total demand is increasing, but expected production at 4.6 billion bushels is slightly higher than our total uses of 4.5, and we should see a slight increase in stocks. Therefore, we're going to see prices a little bit less. We're not trending like the corn market is. If you look at the chart below, I've drawn 2 orange lines that are kind of showing that channel. Soybeans seem to be traded in between 14.50 and about 15.40. Be interesting to see if soybeans break out of that trading channel or not. But been trading there since early April in that range. But still, we see the moving averages. We still see higher prices for each shorter period, but the gap is getting a whole lot narrower. The 50-day average is at 14.85, and the 5-day average is at 14.98. So I think we've lost some of the momentum in that soybean market, and we may be nearing tops for the short-term period until we get some more information or some weather scares start to influence the price. if I hadn't labeled this as December cotton, you might think we were still looking at the December corn chart. Again, it's been steadily climbing. It didn't start right after the invasion, but it's been climbing ever since the middle of March, pretty much consistently. Looking at those moving averages, again, there's pretty good spread between the 5-day, the 20-day, and 50-day averages. This market seems to have momentum to, continue to move upwards. But looking at the USDA's supply and demand report, it was interesting that when surveyed back in March, producers expect to increase planted cotton acres by 1 million acres. But now, because of some drought in the Southwest, USDA is forecasting a decrease of 1 million acres in harvested acre. So that's a pretty big swing. That's, to drop 1 million acres of harvested cotton when you're increasing planting by another 1 million. You can see that the trend line yield is higher. That's based on regional averages. So South Carolina and North Carolina are probably averaged together based on their production. And that would compare with Texas expected yields and their acres. But that's a weighted average expected yield of 867 pounds an acre. See supply, total supply is dropping. Total demand has dropped a little bit also. And ending stocks are certainly headed down. The thing to watch on this cotton market that is very highly valued right now. I mean, cotton is trading in the $1.30 range. It's just watching to see if that harvested acres number improves as we go through the summer. It's not likely to, but if it were, we could see these ending stocks start to level out or possibly increase. The other thing is we need really strong exports. Where USDA is forecasting 14.5 million bales to be exported. And if that slips a little bit, we could see, ending stocks rapidly climb. So cotton's going to certainly need to be watched. If you have not priced cotton at this point, this is certainly an excellent opportunity to lock in some of your production, even though we've seen big increases in the cost of production since first of the year. And that brings us to wheat. Wheat, we've known a lot about this crop, but this is, again, the first official USDA outlook on wheat supply and demand that was released last week. We see the yield is expected to be about 2 bushels an acre higher than last year. Harvested acres is practically the same. So we're going to produce about 1.7 billion bushels and use just under 1.9 billion. We're going to see a continued decrease in ending stocks. These wheat prices are certainly very high. The moving averages are just like corn and cotton, showing you a lot of growth over each of those various periods. So we still have some strong pricing opportunities. The problem is end users have been hesitant to buy wheat against the July board because of these high prices. So you have to monitor your cash price, not just your futures price, as you're pricing this wheat this summer to lock in profitable opportunities. So we see a slippage in basis, but we're still seeing good cash prices compared to previous years. It's just that the basis isn't nearly as good as it usually is. So that kind of gives us a quick summary of wheat, cotton, soybeans, and corn. Again, all 4 crops offer us really strong pricing opportunities today. The crop insurance guarantees are really strong right now. And we just need to see if we can get the weather we need to have that good crop in South Carolina. So with that, we're going to there's any questions, we'll be glad to take those. If you just want to type them in the chat box, and I will give you time to do that. Just want to make another plug, remind people that through a USDA grant, we are able to offer through the South Carolina Agri Wellness Program, free counseling services through SUN EAP to farmers, farm families, and other people involved in South Carolina agriculture. So I'll leave this slide up so you can see the phone number and the website. And if you or somebody you know could use some agri wellness, be sure to reach out to this number and mention agri wellness when you call. So with that, we'll see if there's any questions, and if not, we'll bring it to a close.